All right, a lot going on in the markets today. Just like we looked at yesterday, the markets had a nice little bounce off of the Fed interest rate hike. And today is a down day. Markets are selling off. We'll take a look at where they're at. As we always like to say, the momentum into the close gives you a real indication of what investors are thinking. A lot of it's technical trading, technical bounces. If the Fed does this, then do that, in terms of algorithmic trading inputs. But the bottom line, what's going on with that is that the market wants, they want assurance, they want clarity, they want to know, what's going on. The markets like certainty. They do not like uncertainty. So the Fed has regained a little bit of their credibility by coming out with that 75 basis point hike. So the market likes that. It likes certainty. It wants to know, that the Fed, number one, has a grip on what's going on. That number two, they acknowledge that there's issues, that inflation is real. And number three, that they're going to act to get it under control. And the Fed came out, raised the rate 75 basis points and said, hey, we're going to hike next meeting 75. We're going to look at the data. And if it's worse than what we think, we'll be more aggressive. If it's, he basically said we're going to be sensitive to the data. So the market rallied on that. Hey, the Fed is awake. They get it. They see what's going on, and they're going to actually do something about it. So there is certainty. Markets love certainty in that regard. So why is it down today? Because now is hangover, right? Yesterday was the party. Today's the hangover, where the markets wake up and go, wait a minute, the Fed raised rates 75 basis points. And they said, we got to raise them 75 more basis points. And there were some other nuances in the language that they talked about in terms of what their target is for Fed funds rate, target for inflation, things like that. And the market's going, wait a minute, to hit these targets, they have to do a lot more work, a lot more damage, and a lot more demand destruction. And this is going to take a lot longer than everybody thinks, because inflation is going to print hotter for June than it did May. So it's going to come in hot again. And, there's going to continue to be issues as we go along getting through the end of the year. So this isn't going to happen anytime soon. The market's going to continue to have to unwind. So that's kind of what's going on. The real question is, and it happened the last couple of times that the Fed raised rates, the exact same thing. Market bounced on the news, and then it sold off for a week afterwards. The question is it going to sell off for a week this time, or are we just going to get a couple of days? Are we going to bounce tomorrow? When you're in a bear market, you can get some really nice aggressive bounces as the market works its way down. We'll take a look at a little bit of that. So let's go ahead and jump in and see what's going on, and take a look at, no, we don't want chat. We want to share screen. Sorry about that. Hit the wrong button. We're going to go ahead and share the screen here and take a look at this. And, a day after the assurances about the economy, markets are worried that the Fed is going to break something. So Jay Powell came out with the insistence that the central bank is not deliberately trying to cause a recession, and that the economy is on solid footing. Exactly what someone in this position would be expected to say. So he's saying the economy is strong, that it's doing well, it can withstand rate hikes without going into a recession, soft landing. He's trying to unwind all of the liquidity in the markets without causing a recession, although we're likely in one and have been in one. What the market is worried about, even before you get to a recession, is a policy mistake, that the Fed breaks something. The market is also questioning his commitment that the comment that the economy is strong. I mean, I don't know where he's getting that the economy is strong. So very interesting comments. And I guess he's basing that strictly on the labor market, because we're going to see as earnings come out and things like that, we're already seeing retail sales down. We know that the inflation's affecting people's ability to spend. So strong economy, and he's just basing that strictly on the jobs growth. And this is what he said right here. At minimum, growth was going to slow even before the Fed started pressing on the brakes, said Tom Porcelli, U.S. economist at RBC Capital. The evidence on that is seemingly growing on a pretty consistent basis now. With all due respect to Powell's comment, it's just not consistent with the data on the ground. So again, they're regaining some credibility, but they're missing on some other fronts. And this isn't just the United States. So this is going on around the world. The Swiss bank raised rates. European Central Bank is raising rates. So a lot of countries around the world are dealing with inflation, same problems. They're all having to raise rates, and they're all dealing with all the liquidity that's been pumped in the markets. And that's the next big contemplation, is what the Fed has to do to unwind the balance sheet, how the markets are going to react to that. The bond markets are already all over the place right now. So markets are down right now at the lows of the day. So they're selling off into the close, down about 2.7% on the Dow, 3.5 on the S&P, 4.5 on the NASDAQ. And let's take a look at Bitcoin is obviously down as well, dancing on this $20,000 previous all-time high level. A lot of people in the space don't think that that previous all-time high can break. And I think once we lost the $29,000 level, that was the institutional targeted level. They didn't step in and prop this up. They let it fall. So I think it's only a matter of time before 20,000 breaks and Bitcoin goes to revisit some of these previous cycle lows right in here. So here's the previous all-time high. You can see the line just, kind of tap dancing on it right now. And the next stop, once it breaks that level, you really have, a little bit in this market structure, area to slow it down, that 19.5, to 18,000 to 19.5 range. It looks like price is wanting to go down there and play with that range and dance around. And if it breaks that, then you're back down into this $13,000, $14,000 range here where price could dance around 12, 13 to see what happens as the economy continues to unwind. So this is a very different time than a lot of people in the space have ever seen or used to. This is a bear market. What's going on? Let's take a look at the hourly range here, because this price action right here, this drop in the price action right here looks like where it was back in the 12th of May after the last Fed rate hike, right? Price dropped. Here's the fourth right here in this area. Price dropped all the way down after that. I think we measured that at like 30-something%. And then it, had these violent bounces and reactions along the way, had a couple of these big price jumps, and then ultimately dropped off again off of, getting ready for the Fed hike. And then now it's working its way back into this bouncing consolidation phase. The question is it going to just sit here and bounce around in this range? And this range is 20 to 22. So let's look at that on a percentage basis. That range is about, it's about 12% range, nice healthy range for price to bounce around in. And that's about after the price settled over here, what this range was about 10, 11%, right? So Ethereum's kind of doing the same thing. Ethereum is testing that $1,000 level. It's already busted below its previous all-time high. So, at the lower end of the market structure for Ethereum, if it loses this, then Ethereum's next stop is going to be that $700 level. If it loses that, then you have some market structure down here around that $500, $600 level. So it looks like Ethereum is ultimately working its way down to that. And with what's going on in the market, in the economy around the world, you just have to expect that these prices are going to visit those levels. And, again, this is a very different time than a lot of people are used to that weren't around in 2008, 9 or before and haven't seen what a true bear market looks like, how long it actually takes, and what's going on at these levels and what can happen, right? So the other thing is there's a lot of issues out there from a structural standpoint in the market, but let's take a look at this real quick. So here's your market. Here's what's going on right here. And here's a chart a lot of people have been talking about, the psychology of a market chart. And really where we've been is complacency. So if you think about the narratives in the space, a lot of the influencers out there, they've all been in complacency. They've all kind of just thinking that, we're going to get back to new all-time highs. And, this is all going to, turn around and everything's going to be fine, right? We're in a bear market. The Fed is out of the game. There's trillions of dollars of liquidity that's being sucked out of the market. Interest rates are rising. Cost of capital is up. There's a lot of zombie companies that are going to collapse because they've been living on debt. They can't afford it now. They're not making profits. We've got contagion in the crypto space. You have, DeFi platforms, that are in trouble because of the leverage. And now with the value loss of the assets, they're having margin calls. So a lot going on there that, that's what happens, right? So you reach all-time highs. All of a sudden you start getting bad news. You get all the FUD. Then all of a sudden you get some systemic risks and structural cracks. And then that leads to the anxiety phase. So we're at the very edge of anxiety right now. And if we go back and look at the price chart, that's what this is doing. Let's look at the hourly especially. This is creating a lot of anxiety for people. Every time this price taps these lower levels here of that 20,000, because everybody knows, pretty much, not everybody, but most people realize that if it breaks 20,000, it's going to go down and test these lower levels. And that's just the technicals, right? That's just the reality of the situation we're in. Thinking that this is going to automatically turn around and just, retrace or go to new all-time highs, that's just not a realistic probability. It would take a lot of capital coming in. Capital is getting out of risk right now. They're getting away from the riskiest assets right now. They're going into safer risk assets, and the ultimate safest assets, which is the dollar, which the dollar is down today too, interestingly enough, but it's been trending up. and bonds and treasuries, right? And those have been, skyrocketing in terms of the amount of capital going into that, which is lowering yield. So there's some issues in the bond market as well. So anyways, this creates a lot of anxiety. So going back to the psychology of the market, you have this complacency phase, then you get to the anxiety phase and almost a denial phase, right? So this is kind of where we're at here. Anxiety and denial kind of live together. What we have not seen is we haven't seen panic. We have not seen panic yet. If Celsius goes down and 3AC or 2AC or whatever that is, investment group or market maker, whatever they are, if they, I think they're an investment fund, if they go down, and you start to get, an exchange collapses, what's the real risk that an exchange could collapse? Well, most of the exchanges made it through, that are around Binance, Coinbase, they were around back in 2017, 2018. Coinbase is a public company, Binance is not, but they say they're hiring. So, the chances of the exchanges collapsing are, less likely than the DeFi, platforms and organizations and stable coins like Tether collapsing. Those are more probable and likely than, some of the exchanges. But the exchanges are laying off some of them. Their fees are down because there's not a lot of trading going on. But Binance is racking up. They say they're hiring. So interesting there, how that's working out. But anyways, so that's where panic sets in, right? Panic sets in where all of a sudden Celsius collapses, 3AC collapses. You get some issues with maybe an exchange out there that's not quite as capitalized, that might collapse possibly. The bigger ones will probably be okay. You get some of those things going on, and that creates panic. That's when the markets sell off. You get something that happens over in traditional markets. We're already seeing some bankruptcies with interest rates going up. That that debt that those companies have borrowed, that affects that. So their interest payments rise, so it affects their ability to operate. So you'll see some bankruptcies, you'll see some companies failing, you'll see some layoffs, those types of things. But there's other areas of the market that are hiring, so the job market might balance out. But we have not seen panic yet. We haven't seen panic selling. What we've seen is an orderly unwinding, deleveraging, and repricing to this point. Once you hit panic, you'll know it. People will be freaking out. They'll throw their hands up. That's when you get real capitulation from a lot of people that say that they're not going to sell no matter what. If that price breaks 20 grand, you're going to get a lot of people selling. And then it gets down here where, there's some anger going on right now, understandably so. But it gets even worse down in this area. And then, then it starts all over. And another way to really look at it simply is this right here. So, the market works in peaks and cycles, right? You have contraction, you have expansion. The peak is the point of maximum financial risk. That's counterintuitive for a lot of people. A lot of people would think the peak of the market, man, that's safe, that's great. We're going to all these, new highs. That'd be a great place to enter. That is your point of maximum financial risk. The bottom here is the point of maximum financial opportunity. So, that's where, the real moves are made for a lot of people. Generational wealth for a lot of people is created at the bottoms. This is when I've made my biggest moves in the market, starting in 2009. In traditional markets, never did anything in stock markets till then. And then again in 2018, then again here recently in 2020. Those are when I've made the biggest moves in the markets, is when they've completely unwound, because I just, before recent times, didn't have time to really monitor markets and things like that. And I was more bigger moves in and out. And then you get back to the expansion where you get back to recovery and prosperity once again. Key is get out up in these areas, get back in down here, and get out up here. And, somewhere along in these curves in terms of getting in, but getting out at the top, right? And a lot of people say you can't time cycles. The indicators were there last November, December. If you go back and look at my videos then, I was talking about, that was it. Several people were calling that as the time to get out. And I think, like I've said on other videos, Thanksgiving, at my house, I was telling everybody to get out when they were asking me about it. I said, it's done. And that was because of what the Fed had to do and was going to do and what was getting ready to start. Not because I'm a genius. It's because inflation and the Fed. As soon as the Fed gets out of the game, that changes markets. And that's the big thing that a lot of people, aren't realizing, is how important and impactful the Fed is, interest rates are, liquidity is to the valuations, not just in stocks and cryptos, but in all assets, right? Real estate, companies, SPACs, venture capital, equity capital, and that's all around the world. So that's what's happening. That's what's unwinding. And that's what we're seeing right now. And then the next question is, okay, so what's a good entry point? Right here, if you buy at 20,000, can you go wrong? A lot of people are advising people to buy in here at 20,000 and saying, hey, this is a generational opportunity. You'll never, be able to buy here at these levels again. Well, we heard that all the way down. So the real question is, are you okay? So you got to make your own decisions. Are you okay buying here at 20 if it goes down to 3,500 and stays there for a couple of years, and then maybe, takes a couple of years, a year, 2 years, whatever? We don't know. I don't know what the market's going to look like in 6 months or the economy. There's no guarantees. It doesn't look like it's going to V-shaped recovery by then, but I don't know what bad can happen from a contagion structural standpoint, like 2009, where we saw banks failing and things like that. I don't know what can happen between now and then, but what I do know is things can happen, because I was in it back then, and banks started failing, and liquidity dried up, and it was a big problem. The Fed, that's where QE started. That's where low interest rates started, and the Fed can't do that this time. Central banks around the world can't do that this time. There's other things they can do. They can directly bail out companies like they did back then, and there's other things, but they can't do what they just did. They just can't do it again. The consumer can't take it from an inflationary standpoint. So that is the big caveat that's out there, is that, that has to get under control, and, that could be a multi-year process. So are you okay with that? Can you handle that? Because that may be where it is. Then the real question is, well, where does it get back to without the liquidity in the market, without zero interest rates? Because we all know where we were was based on zero interest rates and tons of liquidity. So as the market reprices, what's the real value of the markets at the end of the day? And that's what this is all about. It's unwinding, trying to find out, with interest rates where they're headed in the Fed's target and zero support from a liquidity standpoint, where is a fair value for companies, equities, venture capital, stocks, real estate, everything. So that's what all of the assets are in the process of figuring out. As you can see, I've been targeting pre-pandemic levels. The Dow is almost there right now, back to its pre-pandemic level, which it's right now about, well, it's not far at all, less than 1% away from. So we'll see if that level, tracks. Then you've got that 2018 level before the market sold off the first time. And then my worst case scenario, like I said the other day, is, before QE and zero interest rate started, which would be back, 2009 levels. Now that's huge. That's hard to understand and contemplate. And I'm not saying that that's a reality right now. I would say right now it's not super realistic, but it is a probabilistic chance. I don't know what percentage. If I was in statistics, that I would give it. Excuse me, my throat's dried up. But, it's in the realm of possibility given where we are now. And when you look at how bear markets unwind, let's go to the weekly here on the Dow Jones. This is panic selling, right? We haven't seen panic selling. This is an orderly unwinding. This is panic. That's capitulation. That's panic. We have not seen that yet in any of the assets. So let's go back to the last time we saw a bear market, and an orderly unwinding, and then a panic phase. So this is 2008 and 9. This was an orderly unwinding. We knew the economy was, there was some stuff in there that was happening, but it started on these first couple of legs of a little bit of unwinding and then panic. This was the banks collapsing and failing, and you had panic. So there's a real big difference between an orderly unwinding of markets. Let's look at the NASDAQ, see what that looked like. Obviously, you see the dot-com bubble, but that's totally different than 2008 and 9. Same thing with the NASDAQ, a very orderly kind of unwinding like we're seeing now, and then just panic. That's just straight down. And that was basically a 47% drop to the bottom of that panic. Let's look at the S&P. Same thing on the S&P. Where are we at here? Here you go, 2008 and 9, right there. And there was a, somewhat of an unwinding before that back in 2000, but here we are, 2008 and 9. Started out just, nice orderly fashion, and then bam, banks failed, systemic risk, global structural issues in the banks around the world, and credit markets, 47% decline. That's panic. We have not seen that yet. I'm not saying we're going to. The Fed is trying to avoid that. What the Fed's trying to do is they're trying to have a nice, orderly unwinding of the markets without panic. But, if the markets did drop, from that level where the panic started, or even 47% from where we're at now, that takes you back to, March 2020 lows, right? Which is in line with, that's still higher. So even March 2020 lows. So is that possible that we get back to March 2020 lows? That's probably more probable and more realistic than 2009 levels. So, potentially we could get back, and a lot of stocks are already there, right? And when you go look at like ARK, for instance, let's take a look at ARK. ARK's already there. There's your March 2020 low. I think, let's see who else is there. Zoom is probably there, the stay-at-home play, all the innovation, they're there, busting below it. Let's look at Facebook. I think Facebook's there, believe it or not. Close to it, Facebook. What about Apple? Where is Apple? Let's take a look at Apple. Bang. No, Apple's not quite there yet. Apple's got a long way to go. Don't know, if Apple will get there, can get there, whatever, but you can see that orderly unwinding and repricing, right? What's Apple really worth? Given the zero interest rate environment that we're coming off of and contemplating where rates really should be, real rates. At the end of the day, the Fed funds target rates, of whatever they're targeting, 3.5%, 4%. Ultimately, what does that represent from a valuation of equities, venture capital, stocks, real estate? We already see the real estate market correcting and reacting to these things. So let's take a look at Bitcoin. And here we are, still 20,960, still playing with that range. So we'll see if this holds. And again, if that breaks, then obviously, you're going to go test those levels. You could get a nice little bounce in here. But I think right now, what's more likely is maybe it just bounces around and really tortures people, creates more anxiety before a panic phase sets in, as long as it can. But if you start getting some, exchanges, DeFis, things like that, failing and stuff like that happening, and people having to liquidate assets to stay alive. Micro Saylor's, he's come out and, talked about the levels that he is looking at and would be forced to liquidate. And he says he's good all the way down to 3,500. And, I hope he's successful, right? He made a big bet. It would be great for the space if this holds. And he ultimately turns out to be, one of the biggest heroes in this whole area here. That would be fantastic. And I think we all want to root for success, right? We don't want to see people fail. And hopefully that holds up and that works and his bet plays off. And that would be great for the space, as would regulation and things like that. So, those are the things that I'm looking at right now. I like to keep it simple in terms of, where we're at, what we're looking at. And let's take a look at this right now. We'll go ahead and put it on the weekly and take a look at that, 200-week moving average. We're already below that. Is the week going to close out below there? We'll have to see. That's something that would be different and new if that were to happen. And this is a different, yes, this time is different. It's a new, different environment. There's your Gaussian channel. Generally that, when the Gaussian channel goes red, we've already looked at that. You stay in it for about a year in the red cycle. So we'll just have to see how that plays out in the long run. And then one other thing we can take a look at here again is your buy signal, right? When is the buy time? A lot of people are saying now is the time to buy. Miners are still capitulating. They're still selling. And we've been looking at this Bitcoin hash ribbon indicator in terms of miner capitulation. And this is what you saw last year about this time when the miners were capitulating and, how long that was. And I think that was we're on the daily chart now. This whole capitulation event was about 66, 67 days, couple of months. So Bitcoin is just getting started here. And we've seen a little tease over here where, there was a little bit of capitulation and then bam, price was off to the races, a little bit of capitulation here, down in this area before the ultimate drop. So could that be going on? Could this just be a minor capitulation here in this area? And then, you get that next leg down, kind of like over here, repeating this level. And if you look at that, what does that represent? Let's just go from the bottom of that cycle. It was another 12%. So what happens from here at the bottom of this cycle? If price drops 12%, let's take a look at that. Whoops, got hung up there. Let's take a look at 12% from here. So that's not too bad. That's 18,000, so it seems like price is kind of working its way that way anyways, almost like it's, bound to get to that point. So here is your Bitcoin hash ribbon indicator. And let's go ahead and put the price candles back on here again. Let's go ahead and pull this hash ribbon indicator back up here again. Let's get it on the log scale, take a look at what's going on here. And, from a color code, as you see this, start to turn blue, dark green and blue coming off of the capitulation, that's when you know you're getting close to your buy signal. So keep an eye on the hash ribbon indicator. And, as you see, it's turning lighter green while you're in capitulation. And then eventually it does turn into dark green. And that's when you ultimately get that buy signal. So that's just something to keep an eye on as we go along with, what's happening. Ethereum, we kind of looked at that. Altcoins, they're all basically on life support, at these lower levels of the range here, market structure. If they lose that, they're back to where they were before it all started back in 2020. Most of them are kind of in that mode right now, trying to see if they are going to hold up in this market structure. Cardano, has had some nice little bounces here. So those are the things that I'm looking at right now. So we'll just keep an eye on it. We'll see how the markets look tomorrow. If there's another down day. Last time after the Fed bounce, there was 5 days of down before there was a major market bounce. We'll have to see if that happens this time. I don't know. I don't know what the markets are going to hold. I just know what we're looking at, what's going on. And, the markets are trying to understand real, true value of assets, given the inflationary environment we're in, the Fed response around the world that we're in, and, the potential for recession, negative growth, things like that. So that's where we're at. Those are the things I'm looking at, and I will see you in the next video.